once you understand what actually changed, navigating 2026 becomes a lot clearer. 12 months ago, investing in tech was almost too easy. Anything with the word AI in the pitch deck was going up. Didn't matter what company or what product, the whole sector was rising together like a calm tide lifting every boat in the harbor. That era is over. 2026 is something very different. The same sector, the same indices, but underneath the surface, a completely different story is playing out. Some companies are pulling away dramatically, others are quietly collapsing, and if you're just tracking the index, you'd almost miss it. This is what's called market dispersion, and it changes everything about how you need to think as an investor. It means passive indexing, just buying the broad tech basket and waiting, is no longer the safe choice it once felt like. You're now getting exposure to the losers right alongside the winners. The easy money is gone. Now it's about knowing exactly what you own and why.
So let's talk about what's actually happening beneath that dispersion. Because when you zoom in, what you find isn't chaos. It's actually a very clean split. Two completely different movies are playing at the same time. On one side, the companies building the physical backbone of AI, the hardware, the chips, the cloud infrastructure. These businesses are experiencing one of the most powerful capital investment cycles in modern history. We're talking about hyperscalers like Amazon's and Google. They projected to spend $650 billion on AI infrastructure this year alone. That's not a forecast built on hope. That's committed capital. NVIDIA remains the bellwether for this entire trade. Despite some short-term pullbacks, every time they report earnings, the message is the same. Infrastructure spending hasn't slowed down. The build-out is active, aggressive, and nowhere near finished. And it's not just NVIDIA. Memory chip stocks are up 55% year to date. The entire hardware ecosystem is being pushed forward by this wave. Now, the other narrative, software. And this is where it gets uncomfortable. Software ETFs are down 24% year to date. Salesforce, one of the most recognized names in enterprise software, is down roughly 25%, despite posting decent earnings. Workday hit a 5-year low following its latest results. These aren't small companies with weak fundamentals. These are industry giants. And the market is telling you something very specific about them. So what's actually going on? It comes down to just one thing, and once you see it, you can't unsee it. For decades, software companies have priced their products aggressively. One user, one license. The more employees a company has, the more software they have to buy. It's a simple but lucrative model, and it worked perfectly. Then, AI promised to make individual workers dramatically more productive. Think about what that means. If AI lets one person do the work of 3, companies need fewer employees. Fewer employees means fewer software seats. Fewer seats means revenue starts to compress. That fear is hammering software stocks right now. And until these companies find a way around it, the market is going to keep hammering away. Now here's the important part, and it's probably the most practical message in this entire video. In a market like this one, price action lies. When broad sell-offs hit, they hit almost everyone. Good companies, bad companies, strong fundamentals, weak fundamentals, they all go down together. The market doesn't discriminate in the short term. You need to own fundamentally strong companies, the ones that are well-positioned to benefit from AI. And if the stock drops 15% because the whole sector sold off on a macro scare, that's not the business model telling you something. That's just the market being irrational in the short term. The trap is letting that price movement shake your conviction when your due diligence is sound. But here's the other edge of that sword, and this one's just as dangerous. A rising stock price in a disrupted sector doesn't mean you're safe either. Plenty of investors held onto Kodak long after the writing was on the wall because the stock had always come back before. Don't be that investor. The only reliable anchor is having deep knowledge of what you actually own. Not the chart, not the momentum. You need to know the business. So where does that leave us? And what's the right move? The answer isn't to step back from the market. It's to get more precise with your investments. And the best strategy for 2026 really comes down to 2 things working together. The first tip is you have to be surgically selective with your tech holdings. This means moving away from sector-level bets and getting close to individual companies. Not just the ticker or the headline growth rate, but really understanding the business. How does AI affect the revenue model? Does it strengthen their competitive position? Or does it quietly hollow it out? Are they a builder of the AI infrastructure, a genuine beneficiary of it, or are they just along for the hype? That last category is the AI-adjacent companies, and this is where a lot of the risk lives right now. The profile of a real winner in this environment has three common traits. 1. Strong underlying fundamentals that exist independent of the AI hype cycle. 2. A clear and specific relationship with AI that makes the business better and not just a better story. 3. The resilience to absorb short-term volatility. That's the first move. The second one is equally important and more overlooked. Look beyond tech. The benefits of AI efficiency, like automation and data processing, are no longer hidden in Silicon Valley. They're landing in logistics, in healthcare, in financial services, and in energy, sectors that were largely ignored during the pure tech mania of 2024 and 2025 are now seeing real earnings growth driven by this convergence. The most attractive opportunities in the next 12 months may not be in a tech stock at all. So the dual strategy is this: ruthless selectivity inside tech and genuine openness to where the AI wave is lifting boats outside of tech. The easy money phase of this cycle is over. What comes next rewards a different kind of investor entirely, one who does the work. We're in a fascinating moment in markets right now. Confusing on the surface, but things are actually quite clear once you know what you're looking at. The AI cycle isn't over. The investment opportunity isn't gone. But the chapter where everyone wins just by showing up, that chapter is closed. What's left is more interesting and more rewarding for the investors willing to do the work. So as you think about your portfolio, here are the three things to carry with you. Know the company. Understand the cycle. Look past the price action. That's the whole game right now. Everything else is noise.